I don't think any investor is making an investment today if it's either not in AI or you're not asking yourself, what are the implications of AI on this investment? And, it's crazy. So if you look at some of these foundational large language models, they're raising 5, 10, I think OpenAI has raised over 13 billion US dollars, yeah. Right? And that again is venture capital. Like, let me put that into perspective. The two of the best venture-backed IPOs that have happened in the last 18 months are Reddit and Rubrik. They have market caps of 6 billion and 12 billion respectively. These large language model, foundational AI companies have raised more capital than the market cap of these successful IPOs that have happened.
Is this thing on?
Yesterday's price is not today's price.
Hey everybody, welcome back to the Run the Numbers podcast. I'm CJ and I just had a conversation with Scott Voss, a managing partner at HarbourVest's, one of Boston's preeminent venture capital firms. Scott takes us deep into the world of secondaries, continuation vehicles, and sidecar funds. This one has it all. It may have the most signal per minute when it comes to understanding the venture capital ecosystem, at least out of the conversations that I've had so far. And Scott also takes us deep into succession planning in VC and at private equity firms. That's a juicy one. Succession planning within private equity partnerships, it often involves complexities. How do you pass down this valuable firm that you've created to the next generation of investors? All this and much more after a short word from our sponsors. Being an operator is not for the faint of heart. It often feels like you're jumping out of an airplane and building the parachute on your way down. CEOs, CFOs, COOs, and BizOps leaders feel my pain. That's why I joined Operators Guild. It's home to more than 1,000 of the most elite, high-growth operators in the world. Think the Special Forces for business scale. Members have access to over 150 in-person events across all 25 global chapters. The modern startup founder, CFO, and COO are really just multidisciplinary problem solvers, which is why having the best problem solvers together has created the ultimate diversity intelligence of any operator group in the world. Operators Guild gave me the chance to meet my own personal board of directors, people I can bounce ideas off of, and their online forum allows you to get answers from your peers as questions pop up. Like, how do I run an employee secondary? Or what should I pay as a base commission rate on SaaS deals? I've made great friends through attending their highly acclaimed OG Summit and frequently attend their online masterclasses taught by the best tech operators in the business. Join Operators Guild and access the Navy SEALs of high-growth business scaling, a group built by operators for operators. Learn more and apply at operators-guild.com. That's operators-guild.com and tell them CJ sent you. They'll hook you up. Annual planning season is upon us. That's right, my favorite time of year. And it's not just about setting goals for the coming year. It's about ensuring you have the right tools in place to measure and achieve those goals. As a SaaS CFO, I know having access to reliable, real-time metrics is crucial for my annual planning process. That's why I'm so excited to partner with today's sponsor, Maxio. Maxio is a billing and financial operations platform that helps subscription businesses reconcile bookings, billings, GAAP revenue, and SaaS metrics automatically. By the way, guys, bookings, billings, GAAP revenue, not the same thing. Got to get them straight. Because these numbers are the foundation of your financial models, it's important to have quick access and trust that they are correct. Don't let the complexities of SaaS finance and accounting slow you down. If you want to start 2025 with the right tools, check out Maxio by visiting maxio.com/run the numbers. That's maxio.com/run the numbers. Request a demo through our link to support the podcast, ya boy, and receive a 10% discount on your first year with Maxio. That's maxio.com/run the numbers. maxio.com/run the numbers. Please, guys, I really need this. Scott, welcome to the podcast.
Thanks, CJ. Thanks for having me as well. Appreciate it.
HarbourVest's, Boston's finest. I can't tell you the number of times I've heard the name, seen the logo, just been around the brand. And so to have a leader like you on it, it means a lot. So thanks for carving out time for us.
Well, it's, again, great to be here. Great to be here.
And like I said, Scott, you and HarbourVest, you're a leader within an area of venture capital that I think is a bit of a mystery to founders and CFOs. And many of them could find themselves with a special partner like HarbourVest on their cap table at some point. So I wanted to bring you on to talk about what your firm does, what you invest in, and honestly, to ask a lot of the stupid questions and follow my own curiosity as it relates to your investment platform and framework, if that makes sense.
Awesome. Let's do it.
So what I want to start this off with is that HarbourVest, in my mind, you're known for being a platform that provides investors with access to private markets. So call it tech companies, and it doesn't just have to be tech companies, but those that aren't publicly traded through funds of investment, secondaries, and direct co-investment. So a lot of words there, but can you walk us through that framework and how it's evolved over time?
Yeah, absolutely. And just to kind of finish this value proposition, if you're if you're an investor and you have a diversified portfolio, but it's comprised of all public securities, let's just take public equities, less than 5% of the companies in the US that make up the US economy are actually publicly traded. So if you want to participate in the broader US economy or European economy, the other 95%, you need a private market allocation. And that's kind of, our fundamental value proposition. So, look, our journey actually started back in 1982. And that's when our two co-founders, our entrepreneurs, Brooks and Ed, set out to raise what's believed to be one of the first, if not the first, multi-manager strategy commingled fund. And it turns out that was a venture capital focused fund. And at HarbourVest, we call it the OG. So over the last 40 plus years, our platform has grown and become much broader in scope. So today, we give investors access to venture capital, growth equity, leverage buyout, private credit, infrastructure, and markets like the US, Europe, and Asia. And we do it through different access points. So as you alluded to, we are a fund investor, which we call primary investor. We're a secondary investor where we provide liquidity to an asset class that's generally thought to be illiquid through our secondary strategy. And we do direct co-investing where we actually partner with our general partners and invest alongside them directly into companies. And we've kind of grown from that $100 million fund one to a firm that has over 130 billion of AUM, over 1,200 employees in 13 offices around the world. So, Brooks and Ed's vision has turned into what I think has been a very good success.
And this is why I was so excited to have you on the podcast, Scott, because you use the term access points, which I think is an incredible way of framing it up. But terms like primary versus secondary versus direct co-investment, these are the things like as a younger CFO, I kind of have an idea of, but it's a bit daunting to me when I see the word on paper. And I know it's just somebody's getting shares somehow, but I didn't really understand how they arrived there or that access point. So maybe to go a step further, I know that you've described HarbourVest's approach as being a network and nodes, and you're trying to ensure all those nodes are thriving. Maybe those are the access points you're describing. Can you explain that concept in more detail?
Yeah, absolutely. So kind of built on the fundamental premise that your network is as good as the number of nodes at the end of your network. And I think, when we think about HarbourVest and our network, it's comprised of two major stakeholders. It's our limited partners who provide us capital, but also our general partners who we allocate capital to. And, listen, the success of our platform really relies on our general partners. They're the foundation and the flywheel that makes everything at HarbourVest successful. So if those nodes are alive and they're thriving, we should be a large investor with those general partners. We should be thought of as strategic to them. We are oftentimes a strategic solution on the secondary side for them as they might be looking for some type of liquidity for a limited partner or even a GP-led deal. And then when they have an equity hole to fill, if they want to invest in a company, but they can only speak for part of the check, we can be a friendly partner as a co-investor. So if we're leveraging those GP relationships the right way, keeping those nodes, very much lit up, I think we can deliver on our value proposition to our investors.
And just to make it more real, when you say general partner, are you alluding to it? I'm just throwing out random names like an A16Z or a Sequoia or an Insight. those types of groups?
Exactly. Whether it's a venture fund or a buyout fund, like the names you referenced, those are the relationships I'm talking about. And for HarbourVest, it's hundreds of relationships, and there are a handful of those relationships where we might have a $2 billion, a $3 billion, or a $4 billion capital relationship across these various strategies that I'm talking about. So, I think when we can do that, it's fair to think that we're thought of as a strategic partner to those types of organizations.
Well, it's also strategic because it's pretty hard to form bonds with some of those companies. They may not be, out in the street exactly begging for capital or anything like that.
Yeah, when I talk to our investors and I tell them what our value proposition is to them, I think there's multiple ways we deliver value, but two that I focus on are, one, access.
Exactly.
Where if you're a new entrant to the private market asset class, it probably doesn't take you long to figure out who the best managers are, but because they've been so consistent and persistent with their performance, it's hard to get into those funds. So by partnering with us, you gain serial access. You benefit from the 2 or 3 decade relationship that we might have with some of the names that you've referenced. But the other part is probably the harder part of what we do. It's through 40 years of experience, we've developed frameworks that kind of signal to us what success factors would be for a newer fund or first-time fund. And so the other piece of value is identifying managers before they become well-known to the market, investing with them, oftentimes being their founding investor, their anchor investor, and then growing with them as they kind of establish market leadership going forward.
Me and my buddies, we'll be having a couple of beers, and we're finance nerds and startup nerds when you say this, but you'll be saying, if you could get into any fund as an LP, who would it be? And I joke, maybe it would be like Sequoia in a certain fund, but they're not picking up the phone for CJ Gustafson to put his, $10,000 in. But it really resonates with me when you say you get serial access to these firms through a company like HarbourVest.
Yeah. I mean, it is fundamental. And some of our investors use us to initially gain that access. And then, they develop a sophistication of their own along the way, and they complement the things that we're doing for them in the future. So,
hey, Scott, you'd mentioned taking, and I don't know if it's taking a bet, but basically putting your money where your mouth is and investing ahead of the success of early fund managers. Can you say more about that? Because it sounds pretty important. I wouldn't call it like a feeder system or anything, but you're kind of scouting the talent before they become big time and investing early, it sounds like.
Well, that's right. I mean, related to this access piece, sometimes if you're not there for Fund 1 or Fund 2, when the manager proves that they can be a very good performer, you don't have the ability to get into Fund 3 or Fund 4. So, in our portfolio, we will take that risk in supporting a first-time or a second-time fund. Now, I think the question is, what is the framework? Like, what type of criteria do you look for, right? And fundamentally, whatever we do, it's team, strategy, track record, structure. Those are things that are important. But on the first-time fund, I think one kind of archetype that we really like is when there's an individual or individuals who learn the trade at a tier 1 organization. They might have built a principal track record for 10 or 15 years, but at the organization they're at, even though they're happy, they're probably not going to ultimately ascend to the leadership position that they want to, right? And they make this decision at 35 or 40 years old to go start their own firm. And that's the perfect time to partner with someone with that profile, because they're going to be hard charging for at least the next 15 or 20 years and want to build an iconic firm of their own. So that is a very common model in our portfolio.
I love that. And you teed something up for me later that I'm going to revisit just for listeners. And that's the succession planning, because that's the juicy stuff. And I find it really fascinating. But before we get there and I get too excited, maybe you could just speak to the process of due diligence and evaluation when you're considering a new fund for an inclusion. So you talked about the manager. What else goes into that?
Yeah, so our typical process, we have an investment committee. It's global, and there's typically 3 phases to a deal discussion and due diligence. So when we talk about a deal at phase 1 in our investment committee, typically there's offering materials from that manager. We've done a certain level of desktop work in due diligence, analyzing team and track record. We have that discussion at IC and figure out kind of what next steps are going to be. In the next phase, we spend a lot of time with the manager. We'll visit them in their offices. We talk with the founders. We talk with the next generation. We want to make sure that there's a consistent story that's coming out of the firm. And then the final phase is just reference checking. And typically a fund will have a reference list that we can call on. But what's nice about the network that we have is we can call off reference too, right? And really kind of confirm the thesis that we might have around that particular deal or manager.
Okay, I get it. And I don't know. What I'm going through in my mind, Scott, right now is how much of investing is really an access game versus actual due diligence. How much is it being really smart to see the investment versus knowing the smart people and having access to them?
Look, it's a little bit of both. And if we go back to what I talked about before, the serial access versus what I'll call the early identification, I think the serial access, it is about access, right? We re-underwrite every re-up decision that we make, but we've known these managers forever. We oftentimes are on their reference list. So that's more of this confirmatory due diligence process, but our value is the access. The harder part in the deep dive due diligence is on the newer relationships where actually we got to forge relationships with those general partners, build conviction around their thesis, and do due diligence around deal attribution of prior track records and that type of analysis. So depending on the deal profile, serial versus new, it dictates kind of the diligence portion of the process, right?
I don't know. I mean, it sounds kind of meta to say, but you're doing diligence on the people doing the due diligence. And I know you do diligence on the underlying companies itself, but you are kind of investing in those people in much of the way that you diligence the
totally true. And if you think about the other areas that I talked about, our direct investment business, our secondary business are much more transactional. And that's where you're doing a deal underwrite. In the part of the business that I sit in, you're doing a people underwrite, right? You're partnering with people for 10 years. You got to believe that partnership is going to be profitable. And so it is a bit different than what you would think about a traditional deal underwrite, right?
I guess another way of saying it is you're playing long-term games with long-term people. It's less about that one deal at hand.
That's absolutely right. Yeah.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and SeatGeek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. As a CFO, I can say firsthand that the most important thing to know is how money enters and leaves the building. Full stop. Without a simple and easy to monitor financial system, you're flying blind. And I'm the kind of guy who likes to have all my tools in one place. I'm talking checking accounts, bill pay, credit cards, and everything else I need to run a business. I'm pumped that Mercury is both a sponsor of this podcast and a safe place to keep my cash. It sure beats keeping my cash under my mattress again. Plus, it looks slick. I always get angry when back office tools are ugly. Newsflash. Finance people may wear both a belt and suspenders to work, but we like stuff that looks good too. Sorry, I just had to get that off my chest. Mercury simplifies your financial operations with powerful banking, giving you greater control, precision, and speed so you can operate at your best. Make the switch today, like I did. Tell them your boy CJ from Run the Numbers sent you. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Banking Trust. Members FDIC. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP. Bring accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. You had alluded to some of these structures, and a structure that I've been trying to wrap my head around, deep YouTube rabbit holes. So forgive some of the stupid questions here, but at a high level, how do continuation vehicles work in the private equity space?
Yeah, so this is a hot topic in our market, and it's attracted a lot of interest and from investor interest, but also a lot of interest from the press. So private equity is a illiquid marketplace generally. And the secondary market has grown up over the last couple of decades to provide liquidity to what is otherwise an illiquid market. And one of the newer innovations within the secondary market is called the continuation vehicle, or GP-led. And in these situations, like, think about the traditional way to achieve liquidity in a private equity deal in the United States. Like, the ultimate outcome is probably to have an IPO. And then below that, it's probably a strategic sale or a sponsor to sponsor where private equity trades with itself. And then it's, maybe a debt recap or a equity recap. And a lot of those things have not really been readily available over the last few years. Liquidity is scarce, and the secondary market has stepped in and introduced this innovation that structures a deal that gives the original limited partner the option to take liquidity if they want, if that's where their kind of bias is, or they can continue on with that investment with the secondary buyer who steps into the shoes of the existing LPs. It's very much like a tender. If we're not selling our company, but we're creating an option for a new investor to step into that investment and the original investor to step out.
Got it. And the way that you were describing it almost sounds like there are different flavors of these continuation vehicles.
Different flavors of yeah, there are. Look, what's interesting is when the market first emerged, it's probably over a decade ago, they were usually bad news situations. It was a portfolio that was old. The assets were not really exciting. The manager needed to wrap up the fund, and there was a short list of buyers that were willing to go do those deals, but they got done at a significant discount because there wasn't really a ton of value there. The market has matured and evolved, and I think they're, for the most part, good story situations today. They still tend to be in companies that are in funds that are later in their life, and they just haven't fully executed on the value creation playbook. And because the fund that they're in has a 10-year term, the general partner is trying to figure out a better solution that allows them to continue to build value, but also wrap up the original fund in a reasonable amount of time. And then more recently, we've seen some of these formed earlier on in the life of the fund, or even done as single asset deals that just have longer duration. And in venture, I think we've seen some iconic stuff done, and I think we're going to continue to see some more iconic type deals done where people just want to own that asset for much longer than the original 10-year term.
Do any of those iconic companies come to mind?
Yeah, look, I mean, whether if they've happened already or are going to happen, it's interesting when you look at companies like ByteDance or SpaceX or Databricks, right? These are, quote, venture companies that are valued at $50 billion, $100 billion, $200 billion. ByteDance recently at $350 billion, right? They're private companies. People call them venture companies, but those are amazing valuations. One of the managers that invested in one of those iconic companies, their fund was actually in year 15, and they went to their LPs and extended it for 10 years. So it's a 25-year fund. And it wouldn't surprise me if that particular company becomes $1 trillion company in the private markets, right?
Yeah.
So
I joke around that Databricks ran out of letters in the alphabet, so sooner or later they're gonna have to do like round A1 again. But Scott, if I have it right, a lot of this is, they say timing is everything. A lot of it's not a function of quality with continuation vehicles. It's timing of who's holding the asset and what the life of the fund is.
I think that's right. And it's timing because there aren't a whole lot of other liquidity options. So this becomes a liquidity option that you can create. I also think that when other liquidity options come back, it used to be the strategic would fight with the IPO option, and that was like a competitive situation. Well, I think there's a scenario when other parts of the liquidity market come back that continuation vehicles will be competing with those alternatives, right?
Any other trends or innovations that you're seeing? I imagine your phone has been ringing with the lack of IPOs lately, so you're probably on the corner of what's going on.
Yeah, look, and what's interesting, if you go back to kind of where I started, where private markets give you access to the other 95%, I think there's a lot of new investors that are not the traditional institutional investor that are recognizing they want access to private markets. So we're seeing different on-ramps or pipes built into the private markets, and they have different types of structures, right? So the traditional fund model is a 10-year term. It's a closed-end fund that might extend itself for 2 years. And that's been the model for 50 plus years. With some of these new investors, many, through wealth channels, they want a structure that looks more similar to their public market holdings. So there's what are called semi-liquid vehicles that have an evergreen feature, but they also have a liquidity feature that gives that individual more comfort with the ability to get in and out of the investment that they're making. So that's one very real innovation that's happening real time right now. And then on the other end of the spectrum, there's longer dated structures that are 20-year term or maybe just permanent capital, where the investor partners with an institution like ours and just says, I don't want to make a re-up decision every 3 or 4 years. I trust you. I don't need this private market allocation to be my liquidity. So I just want it to be an NAV grower at 20% or whatever the historical rate might be. Now, what's interesting about all of those is I think in our industry, it's generally understood that there is an illiquidity premium. So the more liquidity feature you have in accessing the private markets, probably the lower your return expectation should be. The longer time horizon you have where you don't need liquidity, probably the higher your expectation should be on the return. And so, for those investors that really want that liquidity feature, they might give up a little bit of return, but they're getting the diversification they're looking for, and they're probably getting a little bit of alpha over what their public market equivalent might give them.
Scott, listening to you now makes me think of like a mechanical question that I've often asked myself when I look at cap tables. So sometimes you may see on the cap table, it says investment firm XYZ fund 8. And then underneath it says investment firm XYZ affiliate, like sidecar fund. What are those? And is that something you also get involved in?
So those are special purpose vehicles, and think of XYZ Venture Fund that invested out of their flagship fund into a great company. Through that investment, they have pro rata rights to participate in future rounds that company might raise. Those pro rata rights might result in more capital being available to that investor than their fund might want to invest. So they will go out to their existing LPs usually and form an SPV and give them the option to invest alongside in that round. Oftentimes that's the way a co-investment is actually structured. It's that SPV vehicle versus the co-investor going directly onto the cap table.
Okay, got it. Yeah, there are probably a lot of CFOs nodding their head out there like, yep, I have about 8 of those, and it's about 4% of whatever the actual larger amount that was put in.
Yeah, and look, I think for the CFO, right, the SPV, typically that lead investor, call it the venture capitalist, XYZ, they have the discretion over that capital, whether it came through their fund or the SPV. The investor in the SPV tends to be more of a passive passive investor.
And that's what I assumed too, that they were kind of riding along with the main fund. But it's like an if you know, then you know. If you're a CFO and you've exported a cap table before and the fully diluted percentage doesn't add up, you're like, what the hell is this NIT? And why isn't it adding up? And it's because of like these SPVs that may have like 0.2% that you forgot to add in. But that's just me ranting about it.
That's right. Yeah.
Scott, let's talk about succession planning, not the TV show that I love, but in VC and PE firms. So succession planning within venture capital and private equity partnerships, it just feels like something that's going to be complex. Is that the case? And what are some of the challenges that are inherent in making that generational transition from one group of investors to the next?
Yeah, look, this is an important topic in any private equity firm, venture capital firm. Typically, you have, the founder that built the firm and established, what might be a leadership position in the market, but ultimately that founder needs to kind of step back and step away. And many of these founders want to build a long-term legacy and institution. So in order to do that, you need to have a succession plan in place long before that transition ultimately has to happen. And it happens in different ways. I mean, what's interesting for HarbourVest is we host this conference every year. We call it our GP Forum, and we bring together the managing partners of different firms that we invest with to talk about best practices on how to run a private equity fund. It's a Chatham House rule, so everything that gets said in the room stays in the room. But succession planning is a topic that we talk about every year. It's the most engaging topic, and I think it's something that every firm has to think about. And look, if you get it wrong, it can send a firm sideways or backwards and sometimes out of business. And if you get it right, sometimes it actually can be a very positive inflection for an organization. I think the other thing that's interesting is there isn't one model that works. And so what's very common in private equity is you might see a firm that starts out with a founder or effectively a CEO. And then when succession needs to happen, there might be multiple leaders below that CEO, and it transitions more to a partnership model where people divide up responsibility and are accountable for their swim lanes. And it really depends on how you're structured and what your next generation looks like, what the right structure would be. I've seen organizations go from CEO to partnership back to CEO model, just driven by what the profile of the next generation of leadership looks like.
To make it more real for listeners, if you think about a private equity fund, each one of the funds has its own distinct set of economics. So you may have someone who created the fund, and I'm making it up, they have 40% of the carry economics, and then you're on fund, 13, 25 years later, and they've made it probably pretty damn good if they're at fund 13. And I don't know if they're coming into the office every day. I don't know if they're the driver behind the relationships of the investments. So then you may have a young up and comer or a partner who's doing all the work, and they're kind of saying to themselves, the economics of this might not be what I want to sign up for. Maybe I should do my own fund. So you have like this interesting inflection point where it's kind of like, how do you transition from that, and how do you sell the economics or share the economics, and what's the structure that you use?
Yeah. And look, this is kind of a negotiation that happens like within organizations, and they're all very different, and there's different philosophies around it. And I think for a founder, it's perfectly reasonable to expect there would be some type of founder share.
Yeah. He started the place.
Yeah. But there doesn't have to be, right? And I've seen some of the most successful organizations with the most prolific, impressive founders who have taken the position of, when I walk out the door, I'm leaving everything behind for the next generation. And that is like a very selfless way to approach it. I think in the end of the day, there's a negotiation that happens, and it probably happens every 5 or 10 years in every private equity firm. And it has to be something where probably, unless you have that selfless founder,
right,
everybody is okay with their deal. And if they're not okay with their deal, and they really believe in their capability, they will leave and start their own firm, right?
It is like a cap table in a lot of ways. It's just in a different type of illiquid asset. It's an illiquid asset of illiquid assets.
It is, right? There's economics that flow through a private equity firm, and depending on how you sit on that cap table, it dictates how much of the economics you get, right?
I may butcher the actual math, but Renaissance Technology is one of the best hedge funds or privately held vehicles out there. I think what the founders did, and this is from listening to a podcast on it, the Acquired podcast, what they did is they ratcheted up the amount of carry that went to the newer professionals over time while still owning the actual funds. So you can play different games to put money in people's pockets. But one of the other ways that I've heard is like funds actually selling chunks of themselves. Is that happening at a higher frequency than normal? Because I've heard about it in the news.
Selling to themselves or selling
selling to others, like selling a GP stake overall in the fund.
Yeah, look, there's institutions out there that manage funds that are GP stake funds, and they come in and they buy a percentage of a management company, and that facilitates lots of different things. It could facilitate the transition of a founder. It could facilitate putting money on a balance sheet to invest in growth parts of the business that maybe the manager doesn't have, and so that's become a fairly commonplace within private equity. As a limited partner, we scrutinize it, right? We want to know that everybody's aligned. If there's a third party that actually owns a portion of the management company. When it first started happening, I'd say it was more controversial, but like all of these things, as they happen more and more, I think they become more accepted as industry standard. But we need to be confident that the people investing our capital, making decisions on our behalf, are aligned and compensated the right way.
I mean, to take it to the logical extreme, someone like an Apollo, they're publicly traded, right?
They are, yeah.
Yeah. So I guess that's the total, not up for sale really, but like that's the most liquid it could get, or being able to actively buy a portion of a GP.
Yeah. I mean, private equity being publicly traded is another one of those areas where when the first private equity firms went public, it was somewhat controversial. Now there's a number of private equity firms that are public. It gives them a balance sheet. They can reinvest in their business. And I think what we're seeing in the private markets, and we've kind of danced around this a little bit, is because they've scaled and become much bigger and more diversified than they've been historically, there's actually a stratification in what is a private equity firm and what part of the market are they investing into, right?
Scott, how do you see the role of succession planning evolving as partnerships mature and these industries change over time? I mean, like, where's the puck going with succession planning, you think?
Look, I don't think there's an evolution. I think it's going to be kind of similar to what it's been historically. And what successful private equity firms do is they identify the next generation early on. They begin to transition responsibility as well as ownership and economics in a way that's mutually agreeable. And then I think back to what I was talking about before, it's like, what should the structure be going forward? Is it a CEO, a co-CEO? Is it a partnership? What makes the most sense for that organization at that point in time with the talent that they have, sitting around the table?
That totally checks out. Transitioning a bit, I want to get a broader perspective on the private markets. I'm still thinking 95% of the companies out there private. That's wild. It's like the tip of the iceberg. And so you've had the opportunity to travel the world and you've seen different cultures, especially in the context of private equity and innovating there. How do those experiences of getting outside of the US and looking at private equity in the capital markets influence kind of your view on global entrepreneurship today?
So look, as a partner in a broader private market organization, my true passion is around innovation, venture capital, and entrepreneurship. So I've been fortunate to work with HarbourVest's here in Boston, also have worked out of our Hong Kong office, and I've invested in opportunities everywhere in the world. And, one of the things that I love is just this intersection of innovation and entrepreneurship and having private capital that can invest at that nexus and see what it can do and see what the opportunities are in different parts of the world. As it relates to venture, it used to be, venture capital really only invested in areas where there was technology being invented, where there was actually IP. But more recently, probably over the last decade, the opportunity globally has been at the intersection of technology and basic industry, and that's happening everywhere, right? So whether it's Latin America, Southeast Asia, China, pick your spot. And we've seen some amazing companies come in and emerge from nothing to a market leader, market definer, disrupt the incumbents. And that's what venture capital is all about, right?
Totally. And what do you mean by basic industry? Can you unpack that a bit?
Pick financial services, right? So in Latin America, one of the the most successful venture-backed investments is Nubank.
Yeah.
That's basically a financial services company that uses technology and has been able to do that to build an offering that basically leapfrogs the traditional financial services providers in the region. So that's a great example. So, you hear things like fintech and prop tech and ideas like that across, developing markets around the world, because the thesis in these markets is business model innovation using technology to make something better, faster, cheaper.
Maybe a stupid question. Do most funds kind of sequester off international versus domestic investments? Like, will it be like Fund 5 is for US tech companies, and then like Fund 6 is for international investments? How do they think about that?
So if I heard the question right, there are leading US funds that go global, and what they often do is they'll raise a fund that's focused on India or a fund that's focused on Europe.
Like an opportunity fund, I think is what I'm hinting at here.
It's not even an opportunity fund. It could be, XYZ fund China, XYZ fund India, and they build teams in those markets, and there's collaboration between the flagship fund and the dedicated team in India or China or other parts of the world. And look, there's synergies when that happens, because you see these technologies that are emerging, or these business models that are emerging in one part of the world that maybe, aren't happening in another part of the world, but they should happen, right? So I think there's a benefit to that. I think the one thing I'd say, and the challenge that this global venture model has faced more recently, is we've become much more nationalistic, right? There's certain markets that have kind of become harder to access, or that we've chosen not to access. And therefore, where venture was very much global historically, in some cases, it's people are kind of dialing back or consolidating from that business model.
Yeah, I appreciate that perspective, because I've been wondering myself, are we becoming more global or less global? You did say something that kind of piqued my interest, and that's kind of either noticing what's going on in a different region and applying it elsewhere, or almost taking a playbook. And I remember when I was valuation associate at Providence Equity Partners, they were able to say, look at what we've seen in the telecom industry in the US. Let's try to get ahead of that in places like Brazil or India. And they basically took the same playbook and applied it there. And so then you can have an international exposure with kind of the same ideas. And I don't know if that would qualify as basic industry, but it's kind of taking what you learn in one place and running that playbook back somewhere else.
Absolutely. And I think what's interesting about certain markets around the world is when venture capital first went global, oftentimes you would see the Amazon of Brazil or the Amazon of China, right? It was like, take that business and build your similar business in the market that you're in, and customize it to the consumer that you're selling to. We have seen certain markets now emerge as the inventors of the new that are non-US, that are the inventors of the new technology or the business model, and then we adapt them back into the US. This happened in Israel going way back when, right? That's a place where technology is invented. It's where IP is, and I have this saying: it's invented there but exported to the world, right?
Yeah.
And that's one model. And I think we'll see that in places like China or India, where it's invented there and exported to the US or Europe.
Israel's number one export is cybersecurity companies.
Yeah.
I want to talk about the future with kind of like an international overlay to this. And you'd mentioned China there for a second, and you've spent time internationally. You lived in Hong Kong, you said, within Asia. You told me that you think China will emerge as a sci-fi like innovation hub in the next 5 years. But what's your thinking there? Give it to me.
Yeah, look, specifically, and this kind of ties into what I just talked about, we're in this unfortunate situation where we are not one global economy anymore, right? There's certain things that are a little bit more mutually exclusive. And with China, you don't have to go back more than 3 or 4 years ago, where it was the largest venture market in the world. But because of geopolitics, we don't see as much global capital flowing into China to fund innovation and entrepreneurship. Now that being said, there is innovation and entrepreneurship happening in China, and they have the same opportunities and challenges that we have here in the US. It could be AI, it might be climate tech, it might be electrification. And, in a world where the multiverse is featured in movies and all that type of thing, I think there's a very interesting scenario where 5 years from now, where capital hasn't been going into China from a U.S. investor, China might open the curtain, and we see their society and their innovation has evolved in a similar way as ours, but it looks different, right? It's like that business school case where you take two groups, you send them into different rooms with a problem, they come out 2 hours later with the answer, and the answers are kind of the same, but they're different, right?
Yeah. I just can't decide if this is like a Black Mirror episode or if this is kind of cool but just different.
It's like Deadpool and Wolverine. Have you seen that movie? Like, so halfway through that movie, there's this dog Peggy that's introduced, and I was watching it with my wife and daughter the other day, and I don't think I've laughed ever as hard as I laughed during that part of the movie. It was hilarious. But it is this multiverse of madness, right? That's kind of what it could be. So
it's all simulation. We're just living in it, Scott. Speaking of simulations, what's your take on AI lately? Is that a head fake? Is there an air pocket going on there? What's your perspective?
That one's interesting too. Obviously, it's the AI of everything. I don't think any investor is making an investment today if it's either not in AI or you're not asking yourself, what are the implications of AI on this investment? And, it's crazy. So if you look at some of these foundational large language models, they're raising 5, 10, I think OpenAI has raised over $13 billion US dollars, right? Yeah. And that again is venture capital. Like, let me put that into perspective. The two of the best venture-backed IPOs that have happened in the last 18 months are Reddit and Rubrik. They have market caps of $6 billion and $12 billion, respectively. These large language model, foundational AI companies have raised more capital than the market cap of these successful IPOs that have happened. So I think that always causes a little bit of question and concern. I think, and the other big debate is, where does the value accrue to, right? You have these large cap incumbent companies that hold all the data, and it's clear that in order for AI to work, those with the data will have the advantage. So does it accrue to those folks, or is it the innovative startups? I have no doubt that some of the biggest companies we've ever seen that are venture backed will come out of this AI innovation cycle. But there's probably, like there has been with the semiconductor and the internet, there's going to be a lot of dead bodies along the way, right?
Well, we'll see. And hopefully they don't replace me with an AI host someday. Maybe gearing towards a close here, I want to get some career perspective. You're a very successful guy. Like, I sought you out for the podcast for a reason based on your insights and experience. How much of your career, Scott, do you think is luck? How much of it is talent? How do you square being in the right place at the right time?
So I don't think I'm the first person to comment on this, but I'll tell you what, I have a lot of students that kind of ask me, like, what decisions did you make to get to where you are today? And what I tell them is, and look, if you ask any venture capitalist, successful venture capitalist, they'll probably tell you the same thing. You need to get lucky in life, right? But you need to make the decisions that allow you to get in luck's way. And I think the hardest part is you need to recognize luck when it's walking right in front of you. And sometimes that's not super obvious when it's happening. So, what I tell students is, like, make all the right decisions. Like, luck will cross in front of you, but make sure you're always looking for it, because it might just walk right by you and you didn't even notice. And I have my own anecdotal stories in life and how
how have you gotten in the way of luck? Or what I always say is to try to increase your surface area for luck. But I kind of like what you're saying better, because increasing your surface area for luck sounds like more of a passive thing. You're saying, like, walk right up to it and shake its hand, or get in the way so you get hit like a bus with luck. Like, how have you gotten in the way of luck?
Yeah, so I have a few stories that I tell, but I'll tell you the HarbourVest's story, right? So I was doing my MBA at Babson College, studying the DNA of entrepreneurship, trying to understand kind of what makes startup, activity work and successful. And I had an opportunity to take an internship at HarbourVest, and the interview went kind of like this: it's, Scott, you're going to sit in that corner over there, and you're going to log information into our database. We need you to be here 20 hours a week. You're going to have no interaction with any of the principals at the firm. And, this is not going to lead to a full-time position, but you will be able to put HarbourVest on your resume, and you'll learn a lot about private equity. And And I said, that sounds awesome. I will take that job, because I was doing an accelerated MBA. I worked in this place called Olin Hall for 12 hours a day. And I just wanted to get the hell out of Olin Hall, for 20 a week. And it just so happened I got my foot in the door. I was at HarbourVest. I built confidence in leadership here, and they had a need, and I was present and available. And they offered me a position, and it's 25 years later. And I can't tell you how lucky I have been to be here. And that was not obvious. I had colleagues who interviewed for the same internship and walked away saying, nah, not really interesting. And I'm so fortunate to have kind of made that decision at that time. And, I don't know what I think it was more just, I don't want to be in Olin Hall anymore. I'd rather be at One Financial, and it just worked out well. So,
well, what you're saying too, I think a lot of times you have to say no to something to say yes to something else. And it's kind of scary to make that leap, because you have this one thing that you feel like you're almost like leaping from one side to the other. And it's like, well, I may not like this that much, but at least it's like a known quantity, versus what you really want to do. You kind of got to cut the rope.
I love your pod, and I love Galloway's pod too. And the way he says,
he's one of my favorites.
He's like, go try, like, young people, go try lots of things. Go try lots of things. And it's okay if you decide you don't like it, but you're never going to know if you don't like it unless you try it. Right. So I think that's kind of where you're going with your yes and no,
Yeah. Yeah. Well, speaking of trying stuff, did I read it right that you've taken up surfing midlife?
Yes, surfing is my midlife hobby. Interestingly, my whole life, I always felt I should be a surfer, but I wasn't. And then when I lived in Hong Kong, there's a bit of a surf culture on the south side of Hong Kong Island. There's a beach called Big Wave Bay that does not really have big waves. But when I lived there, I kind of took it up. And as I moved here back to the States, I've just continued to try to develop that hobby for the last probably 15 years. It's hard to get really good at anything after 40 though. So, but yeah, that is my midlife hobby for sure.
Scott, that's so much cooler than saying you picked up pickleball.
Yeah. Related to surfing, and I've said this in other places, my advice to people is to go find a hobby that you can't access on demand. Our culture has become so much of an on-demand culture, and it's really special. Like when there's a good wave, I can't predict when that's going to happen, but when it's happening, I got to go live it at the time that it's happening. And there's something really special when you have that magic moment that is not something that you can just call up. And so that's I guess, a little bit of words of wisdom and advice. The other thing I'd say is, I think you asked me, how do you balance kind of hobbies and work? And what I'd say there is, we all need to be accountable. Accountability kind of gets us up in the morning and drives us through the day, and actually drives us through the year. But I think as we get older, and I think the question is, who are we accountable to? We're accountable to our families, our colleagues, ourselves, and probably other stakeholders. But I believe as you get older, you should be able to dictate and mandate who and what you're accountable to, and that will lead to longevity. And so that's an important message here to leave as well.
No, I think that is powerful. And I'm a Breaking Bad fan. It's like my favorite show of all time, in your head. And so there's this scene at the end, because Walter White is dying and he has cancer. And so he basically becomes a drug dealer and a meth cook to make money for his family, he's saying. But he hasn't really had this other area of success as a teacher in life and doesn't feel fulfilled. And he keeps telling his wife, Skylar, like, I'm doing it for you guys. I'm only doing this because I want to benefit you. And at the very end, she's like, don't give me that BS again, that this is all for us. You've built this huge drug empire. And then he finally says, it was for me. I did it for me because I was good at it. And I enjoyed it, and I enjoy being good at something. And like, I often feel this tension too in a career where you're doing something because you get this energy from it, or you feel like you're good at it, or you want to feel successful. But then, to your point, Scott, you got to be accountable to other people, and that finally getting to that inflection point, or that balance of being able to say yes to certain things at the right time. I think that's a core skill set that I myself, I'm still trying to develop.
Well said. Well said. Hey, listen, I love your pod. And for anybody listening to this pod, one of my favorite pods you've done is the Eric Newcomer one. So I would, if you have a listener listen to this and they haven't listened to that one, I would encourage them to go back and listen to it. I thought it was really well done.
Look at that. We got a fan on the pod. No, that means a lot. Thanks for listening. And thanks for doing all this prep work. Like, I appreciate you carving out time. You could have been anywhere else. So thanks for spending it with us.
Awesome. I really enjoyed it. Thanks, sir.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.